Welcome to the HMO Property Show, by investors for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and I want to say it again, massive thank you to my beautiful wife for stepping in and recording some episodes whilst I've been busy on other things, mainly winning boxing fights and flying to China and stuff like that. If you can, show some love, send her a message, tell her she's great, really appreciate it. Today I want to talk to you about the property market in general, and we were thought that this kind of boom slash shortage slash crisis that we were in was just pre-COVID type thing, and it was going to all quieten down, and Perth was going to slow down and Melbourne was going to take off, and all these market cycles are going to readjust. But the reality is we're still seeing record low vacancy rates, we're still seeing a national housing shortage, and new build construction is now starting to move, but not fast enough. So I think what happened previously, obviously construction prices went up. We were seeing a lot of builders hit the wall, fall over, unfortunately, and it give people nerves. A lot of people sat on the fence. A lot of people didn't want to build. A lot of people turned to the established market, and that put rocket boosters on the established market. We've seen prices double in 2 years in Perth, and it's absolutely bonkers. And it's good, right? It's ignited and pushed every single market in the country. Bar Melbourne. Melbourne's still struggling a little bit. Starting to see some green shoots coming through there, but not a patch on the way Perth is still going and the way I expect it to keep going for at least another 2 or 3 years, unless they turn off the migration tap, which we're going to talk about in this episode. But as long as people still move to this state, we are not building houses fast enough in the areas that people want to live. And whilst it's great that we've got a lot of investors in the market and a lot of people are looking at real estate as an investment vehicle so that they can build wealth for themselves and their families, they are still following the same old playbook of just buy, hold, get capital growth, and they're tied to jobs while they're tied to try to build wealth, which isn't too bad because there's a few people out there that are earning good money, and obviously we can negatively gear and they can reduce the tax and build a property portfolio, yada yada yada. If you've been listening to this podcast for a while, you know that my view is why negative gear when you can positive gear and still come out in a better net outcome, investing in the same street in the same suburb, being $25,000 or $30,000 a year better off. So let's break down what's happening nationally and then what's happening here in Western Australia and what needs to change in the way we think about investing. So let's look at the big picture. Australia's population at the end of 2024 hit 27.4 million people. That's an increase of 445,000 people, almost 500,000 people in just 12 months, which is 1.7%. Vacancy rates nationally are sitting around 0.8%, and a balanced market in any state or territory would be classed as 3%. And in some cities, like Perth and Adelaide, the vacancy rate's down as low as 0.4%, especially in certain suburbs as well. In some suburbs, there's zero housing available right now, which means that tenant supply is extremely tight. And then the housing supply in general, Australia is projected to be short by roughly 400,000 homes by 2029. Now, if you're a property investor and you see that figure, surely you've got to understand that this is an opportunity. Even if you're not a property investor and you hear that there's going to be a shortage of 400,000 homes, that supply and demand swing, not enough supply, too much demand will continue to push prices up. So if you're not a property investor, why not? The market is going to continue to go up. People are starting to talk about affordability brackets and stuff like that. It's been flying for many, many years. It's been totally unaffordable for everybody, but it still goes up in value. So why can't the rest of Australia follow that trend as well? And I really think it's going to, because the supply versus demand metric here in Perth is just carnage at the minute. The government said that they wanted to build 1.2 million homes in 5 years, but the delays, the costs, the logistics, they're all pushing that number out. And the reality is demand is growing, supply is falling further and further behind. And if you're investing like you did 5 years ago without adapting, you're going to run into the same old barriers, which is you're going to get tapped on the shoulder by the bank and say, I'm sorry, Mr. Investor, you cannot continue to invest because your debt to income ratio is too high. And that's because every property you buy takes $10,000 or $15,000 off your income, and we're not going to lend you any more money. So let's talk about Western Australia in general, right? It's the fastest growing state, and the indicators that it's going to continue to grow are very, very sharp and looking very, very good. The population in Western Australia ticked over just over 3 million people in December 2024, and that's an increase of 70,000 people in 1 year. So almost the size of the MCG, moving to a state where they've got the housing availability of, I'm trying to think of a small football team, but I don't know any, 2,000 homes available for rent, 2,000 homes available for sale, 70,000 people moving to the state in 1 year. Now, granted, not all 70,000 people would need a house, because some of these will be couples or couples with kids, etc. So let's say like 40,000 people need a house. We're still well and truly under that supply and demand metric that we're talking about. And what's been going on is sales transactions in Perth metro area are still at record highs, which averaging like 900 sales per week in the sales space here in Western Australia. That's up 2.1% on last week, but it generally sits between like 850 and 950. And literally that's like properties are coming on the market are just selling so fast. Days on market still ridiculously low. Properties are selling fast, and yeah, the middle band of this market is the one that's moving. The lower end's still moving, don't get me wrong, but that middle bracket of 750 plus, that's what's moving now, because that's where the homeowners are going. That's where the people with equity are going, because the bottom of the market's already pushed and pushed hard. At the end of last week, according to REWA, there was 2,869 properties for sale in Perth, and that number is 42% lower than the same week 1 year ago. 42% lower last year. It's staggering, really, isn't it? And we're transacting at 900 properties per week. So just under 3,000 properties for sale, 900 transact. That's 33% of the market that's moving every single week here in Perth. And why does that matter? Because fewer listings mean less supply for the market. Sales are still flowing despite constraints, and you literally can't sell houses fast enough, which with the demand increasing from population growth, migration, rental pressures, it's just going to get more and more expensive for people, and they're going to end up with higher and higher debt to income ratios, which again is going to stop them from investing. So the WA market is showing clear signs of supply constraints and persistent demand for growth. And if you keep buying and expecting the same patterns as last year, I think you could be in with a chance. But last year, like I say, we've seen that bottom end of the market move, and now we're seeing that middle tranche of the market move as well. So what we're hearing on the ground, and I had a podcast with Mr. Mike McGowan, who's the executive director of the HIA. On a daily basis, I'm speaking to different people in the industry, asking them what they are seeing on the ground, because the stats and the data is good, but they are sometimes also a lagging indicator. This is what's happened, not what's happening. And when you're speaking to people on the ground, real estate agents, builders, and people in the seats like Mike sits, you get to see exactly what's going on right now. When we look back at new build construction, and in 2024, we had 20,000 homes built, which was an 18% increase on the year previously. And in the 24-25 financial year, we're going to have 22,600 rooms, houses complete, which is up 25%, which is good, right? 25% increase in construction is good. But when you look at it, it's only an extra 2,000 homes in a time when 70,000 people moved to Western Australia. So under the National Housing Accord, WA's fair share target is 26,000 homes per year. I would say we need to be closer to 30,000. But even Mike said, 28,000 was the most we've ever built in a year before, and that was at the peak in 2013-14 when we had loads of builders and credit was flowing and stuff like that. So even with strong growth in the construction space, we're still, I believe, 3,000 to 4,000 homes short of where we need to be. If we hit that target, right? If we're only hitting 22,000 homes, I still think we're 8,000 homes short every single year. And, developers are building, or feasibilities are starting to look good again, but we're building a lot of houses in the fringes, not in areas where we need them. The state and federal governments want more infill development. However, feasibilities still aren't stacking up that well, so that is giving developers confidence to invest in the sort of inner city rings to bring what's called the missing middle of the market. And this is where the opportunities are for investors right now, if you can buy land at the right price and build at the right price. Because lots of people are moving from the established market because they're getting priced out constantly. We're still seeing and hearing that homes are selling at the first home open for $40,000 to $50,000 more than the asking price because people are getting FOMO, the fear of missing out. And now then people are starting to turn to new build construction because established homes are not only becoming less affordable, but also becoming harder and harder to get. And people are ending up in something that they're not really that satisfied with, where if they can bite the bullet and wait for another 12 months and build something specifically to them, then they're going to get a really nice house that they want to live in and not something that's all they can get hold of. So the gap between what's needed and what's being delivered is getting bigger and bigger and bigger. And this is what it means for you. I mean, if you're a property investor now and you are buying established properties, or you are not buying established properties and not buying new build properties, it means you're sitting on the fence. I think the biggest opportunity right now is in the new build space. I really do. We stopped buying established properties a while ago, mainly because we're just getting smashed at every single home open we were going to. 20, 30, 40 people queuing around the block, going for 100,000 more than what you wanted to pay for it. But the new builds, we've been picking up blocks of land in infill locations and building HMOs on them and like getting some really not only strong valuations on the back end, some of them are like $100,000 to $300,000 in growth. We're getting incredible rental yields on them as well. Absolutely crazy rental yields. And this is the problem, right? For decades, not just investors, but also just homeowners have followed the same blueprint that's been ingrained in them for years, right? I think more people should be moving into the investment space now because for years, a lot of people have been just told to buy a family home, pay off the mortgage, put your money into your superannuation, and then retire and sail off into the sunset. And the reality is that just does not give you a good quality of life in retirement. If you've worked hard all of your life, you deserve more than this. You know, you're supposed to retire at 65 and make the rest of your life the best of your life, but people are retiring at 65 and they're cutting back on all of the good things that they had in their working career because they haven't invested and made their money work hard for them so that when they retire, they can maintain or increase the level of life that they have. The other problem that we're seeing is because a lot of investors that do invest, they like to invest in something that they are familiar with, which is the family home, which means that they will invest in the 3-bedroom, 4-bedroom or 5-bathroom property in the suburbs because that's what they know and that's what they like and that's what they understand. But the problem is the rental market, 70 to 80% of the rental market is singles or couples. And if we're bringing more 4 and 5 bedroom, 3, 4 and 5 bedroom houses, not only are we building houses that are too big, which means that we're paying too much to build them because they're bigger, and then we're trying to rent them out and price them for a family, but a single or a couple is renting them, then we've not only got all these empty bedrooms, but we've also pricing families out of the suburbs that they need to live in that are more convenient for them with their kids and their families and their work and everything else. And sometimes these singles or couples are renting these 3 and 4 bedroom houses because there's nothing else for them to rent. This is when you need to start thinking, if the market is 70 to 80% singles or couples, is a 3 or 4 bedroom house the right thing for me? Or am I just investing because I don't care about who's going to rent it? All I really want to do is just invest in the fact that I'm going to make money. And that's fine. If that's you, that's absolutely fantastic. But there's a better way to do it. You can invest with your heart and consider the social impact or the social investing or the social welfare that can happen when you invest in these properties. You can make money whilst doing the right thing as well, because we just can't build houses fast enough, right? It's just bonkers. Prices are rising faster than wages. That should probably slow back down a little bit. And interest rates, we've seen many high interest rates, or we've seen interest rates go up and we've expected them to come down, but the RBA just haven't come to the party, have they? So yeah, we were expecting cheaper money out there right now, which probably would have sparked the property market even further or pushed it even further or just poured fuel on the fire. So now is potentially the time to consider something different, because if you've been focused on capital growth for a long time, right, there's a good job that you are equity rich and cash flow poor. And at some stage in your portfolio or your investing journey, there's going to be a switch from growth to cash flow. And this is all the other people out there that talk about building a foundational portfolio that's just got capital growth, and then you transition from that capital growth into the commercial assets to get cash flow so that you can live off the cash flow in your retirement. Well, why not just invest in both at the same time? Because cash flow pays the bills, not capital growth, unless you draw down on that equity, but then your debt level increases and your holding costs increase. You should also look at what the demand is, look at what people want and what they need. If you think about it, 78% of the market, do they want a 4-bedroom house? In fact, even the generation that are coming out of school and university now and moving into the housing system or trying to get into the housing system, they don't want a big house with a big backyard that they've got to maintain themselves. They all want to be Instagram socialites. They all want to be, I'm going to say all, the majority of them want to be YouTubers. Even my son started saying, YouTube, Dad, put YouTube on. He want to see himself on there at some stage, I guess. But they all want convenience. They want the lock up and leave. Even the downsizers or the uplifers or whatever you want to call them, we're moving into the convenience world, right? We've got mobile phones where everything is at the touch of a button. It's convenient. There's no resistance. You think about it, in a HMO, it's convenient. It's fully furnished. You can come and go whenever you need. It doesn't tie up a lot of your money. You can save and do the things that you need to do. Also, when you've got like a portfolio that's high cash flow, you can also weather the storm of higher interest rates and economic uncertainty. So if the market does go down, you're still producing cash flow, right? There's nothing worse. And when I first got into property in 2014, it was at the peak of the last boom, and then I kind of rode it down, and I seen people with vacant properties that they paid too much for. They couldn't rent them out. They were negatively geared. They were just bleeding cash big time. But a couple of the investors that invested with us at the very start of the journey, they converted their properties into HMOs and just rode that downturn in the market, and now they're riding the wave back up. But it didn't smash them like a lot of other investors got smashed. They had cash flow coming in, which was great, and cash flow covers that mortgage. It means that you don't have to worry about your investments. So let's zoom out. Every time the market shifts, there's two types of investors, or two types of people. Those that keep complaining about the market and sitting on the fence, and if you sit on the fence, you get splinters in your bum, and those who adapt and capitalise. In the early 2000s, a lot of investors bought in the Perth, the crazy boom that we had there. The winners were those that held through the downturn, adapted and focused on fundamentals. And now the macro dynamics are changing again. So if you're investing in Perth or you're investing anywhere else, are you investing like it's the 2000s? Or are you investing like it's almost 2030? Because it's nearly 2026, isn't it? The way we lived in 2000s was different to the way that we lived in 1980. The way we lived in 1980 was a different way that we lived in 1940 or 1960. The way that we're going to live in 2030 or 2035 is going to be different to the way that majority of people are living now. We're already seeing the shift. I mean, think about all these sharing places. You've got co-living, HMO, rooming house, boarding house, lodging house, whatever you want to call it. You've got Uber, where people are sharing cars together. You've got Airbnb, where people are sharing people's houses and living in people's houses at the click of an app. Like, it's changing. The world is actually changing. And the problem is, if the population keeps growing at 400,000 to 500,000 people every year nationally, and we only build 200 to 300,000 homes per year nationally, that means rents will stay high, vacancies will remain very low, which again not only pushes rents up, but pushes property prices up. And even with higher interest rates, like, these prices will still go up because people will put themselves into housing stress to simply have a roof over their heads. And this isn't about speculation, it's about recognising the supply and demand imbalance and capturing the gap and being in the difference. So I think to wrap all this up, last year we added 445,000 people to the country. 70,000 people moved to Perth, which was the fastest growing in the country, and listings in Perth are down 42% on last year. Construction is up, we're still short of required targets. The gap between supply and demand is getting bigger and bigger and bigger, and if you keep doing what everyone else is doing, you'll stay in that same cycle, just chasing growth, tapped out from the bank. Think a little bit differently, focus on cash flow, demand, supply scarcity, the way that people are living now and into the future, and you'll be one step ahead. So I hope that helps, guys. A little bit of an overview on the market to let you know what's going on out there. Thanks again for joining us on the podcast, and I'll see you again next week.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.